This LOS is describe the effect on a portfolio's risk of investing in assets that are less than perfectly correlated. Covariance and correlation. The foundation for modern portfolio theory is based on a two-asset portfolio, and the learnings from that are expanded into a theory that includes all risky assets in the global market portfolio. So let us start by looking at building a two-asset portfolio. To do this, we'll use a series of graphs with the vertical y-axis being expected return and the horizontal x-axis as being standard deviation or risk. We're therefore looking at the return to risk or risk versus return. The first asset, asset B, has an expected return of 5% and a standard deviation of 8%. The next asset, asset S, has a higher expected return of 10% and a higher standard deviation of 20%. Asset S would then plot higher in the chart as follows on the next slide. For this example, we basically used the same 1928 to 2013 data for the S&P 500 and the 10-year T-bond with a little rounding. Point B represents the bond and point S the stock. Recall that the correlation between bonds and stocks is less than 1. Hopefully, by using some real-world data in the example, the theory is easy to understand. The first asset, asset B, has an expected return of 5% and a standard deviation of 8%. The next asset, asset S, has a higher expected return of 10% and a higher standard deviation of 20%. Asset S would then plot higher in the chart. We'll start by looking at a special case if the two assets are perfectly correlated. That is, the correlation coefficient between the two assets is 1. In this special case, then the line showing the various asset mixes is a straight line. We can redraw the graph with the various plottings showing the different asset mixes, but to do this we need to calculate two things. One, the expected return on the portfolio, which is simply the weighted average of the returns, and two, the risk of the portfolio. To do this, we need to recall the formula for portfolio standard deviation, which I've written here. So here's my data for the graph on the right-hand side. We can see that here's the weight in the stock and here's the weight in the bond. So we start from 100% in the bond. Expected return is 5%, standard deviation of 8, which is basically here at the bottom of the chart. Okay. At the other end of the chart, we have 100% in the stock, 0% in the bond. So we have an expected return of 10% and a standard deviation of 20. So you're up here at the top. Now, as I reduce the weighting in the bond by 10% and increase it in the stock, then of course the expected return is just the weighted average, and the standard deviation, we use our formula. So as I reduce the weightings in the bond and increase the weightings in the stock to the 100%, we have a straight line if the correlation is 1. On this slide, just going to work through the expected return and the standard deviation of the portfolio for the 50-50 weighting. So the expected return is easy. As we said, that's just the weighted average. So 50% times the 5% return on the bond plus 50% times the 10% return on the stock gives us 2.5 plus 5 equals a 7.5% return. In terms of the portfolio standard deviation, we said here we're still working with the correlation of being 1, perfectly correlated. We could see that the portfolio standard deviation equals 14%. Weight 1 squared plus variance 1 plus weight 2 squared times variance 2 plus 2 times weight 1, weight 2 times correlation times standard deviation of the bond, standard deviation of the stock. Okay? Okay, here's the data in the graph or the only thing that we've changed is the correlation between the stock and the bond now is negative 0.5. And we can see that the expected portfolio standard deviation, the expected return on the 50-50 portfolio didn't change. Recall that was 7.5%, but the portfolio standard deviation has gone from 14% down to 8.72. So that's the basics key of this LOS, is that as we combine assets with correlations that are less than 1, and indeed into the negatives, we don't change our expected return on the portfolio, but our portfolio standard deviation goes down. Okay? So here I'm just taking a screenshot of my Excel. We can see that I've put this example to Excel. Sometimes candidates, if you're handy with Excel, you get a real feel for this. So here's my expected return of the stock, 10%, standard deviation of 20, expected return of the bond, 5%, standard deviation of 8%. So in this case, the correlation was 1. And as I said, we're looking at the 50-50 portfolio as an example. Our expected return was 7.5, standard deviation is 14. So here's my correlation. If I change that to negative 0.5, you can see what happens is that the expected return doesn't change, but for every weighting, the curve becomes bent and bowed, and the portfolio standard deviation has become less for every position except for the 100% in the bond or the 100% in the stock. And so again, at 1, it's a straight line. As we hit to 0, it starts to bow. If I go to negative 0.5, it bows even more. And then a special case is negative 1. If they're perfectly negatively correlated, then it's going to actually meet the y-axis. So this is the graph that you see in the CFA curriculum and in many textbooks. But as I said, I just put it into Excel. It makes it a lot more easier to understand, I believe. So there was your 100% in the bond, the lower left-hand side, 100% in the stock. If the correlation is 1, it's a straight line. As we reduce the correlation, the line becomes more and more bent. With the special case of the perfectly negatively correlated -1, it meets the y-axis. And this slide is just a FYI. We've seen it before in another LOS. It's from the JP Morgan Guide to the Markets, which is outside the CFA curriculum, but it's a nice slide because they had the 10-year correlations between different asset classes and the annual volatility. And we can see that indeed bonds and US large cap have a negative correlation of 0.25 for that 10-year period. So we're just going to finish this LOS with a quick practice question. Which of the following statements about portfolio theory is least accurate? A, assuming that the correlation coefficient is less than 1, the risk of the portfolio will always be less than the simple weighted average of the individual stock risks. B, when the return on an asset added to a portfolio has a correlation coefficient of less than 1 with the other portfolio asset returns, but has the same risk, adding the asset will not decrease the overall portfolio standard deviation. Or C, for a two-stock portfolio, the lowest risk occurs when the correlation coefficient is close to -1. So the correct answer is B, because we're looking for the statement that was least accurate, inaccurate. So we can see when the return on an asset added to a portfolio has a correlation coefficient of less than 1 with the other portfolio asset returns, but has the same risk. So we see the correlation coefficient is less than 1. Doesn't matter that it has the same risk. It says will not decrease the overall portfolio standard deviation. But as we've seen from the previous examples, any correlation less than 1 will decrease the risk of the overall portfolio standard deviation. Okay, and that's the last slide for this LOS. Thank you.